I just want to talk about the market reaction here first for a moment, because it does seem like we're coming off the boil a little bit, that this was a quick strike. Iran and Iranian state media seem to be downplaying it. If this is indeed the retaliatory strike that Israel had been promised, could the worst be over?
Well, it's a very dangerous game that is being played, where each part is trying to have the final word. So there can be a mistake, it can go too far from one side or the other, but indeed, the responses so far have either been telegraphed or relatively moderate. So yes, there is a path for de-escalation here, and we could have seen the worst. But of course, the tension remains high, and the possibility of a mistake is obviously there. So we'll need to watch the reactions going forward, but there is indeed a path for de-escalation.
And of course, Samy, you know, you're the chief economist at Lombard Odier, so I don't want to put you on the spot, but if we take this into the realm of monetary policy, which I guess, you know, we can, if we draw the string a little bit hard, pull on the string a little bit hard, does it make it more difficult for the Fed to do its job if currencies are extraordinarily volatile, which, you know, events like this make them?
Not necessarily so. I think what's difficult for the Fed currently is actually the part of CPI that is being driven by demand rather than the supply issues or the energy issues, which are perhaps easier to deal with. The problem with the US is the sticky part that comes from services. Services is demand, and you know, that demand needs to come from somewhere, and that's a robust economy, consumers consuming because they have jobs, because they have rising incomes. So it's from a different side, I would say, that makes the situation complicated for the Fed. And if it's demand, if the economy is too strong, well, you know, obviously what's happening on the energy front and what's happening on the supply front is perhaps not going to help. But I would say the biggest challenge here for the Fed is to manage the demand of the U.S. economy, and that comes from, again, the other side. It comes from domestic America, not from the Middle East.
If we were to see oil above $90 a barrel for a protracted period, if this were to escalate, and, you know, so far there are no signs that it will, or that the Strait of Hormuz or anything like that will be impacted, but if it were, would that be an inflationary problem for the Fed?
So it's the start. I would say we're on the upper hand of a normal range currently. 90 is acceptable, not particularly disruptive, not massively inflationary. Maybe it has a couple of tenths of basis points, but that's totally manageable. I would say it's not necessarily the above 90 level that we would be worried with. It's more above 100. And then if you get to above 110, then yes, Vonnie, you're right. You start, you know, being at the beginning of another energy shock. So of course, we need to be able to prevent that. There seems to be enough supply, at least from the OPEC side, to prevent an escalation of the oil price above 100 or above 110. Just north of 90, I think, is still manageable. But obviously, this is a very key channel of transmission from geopolitics to the real economy and market, is absolutely what happens to energy markets. For now, it's contained, so let's hope it stays that way. But obviously, this is something that we're monitoring very strictly.
Exactly, and you know, before this came onto our radar, so to speak, we were obviously very focused on what happened yesterday, Fed speak-wise, which turned out to be very hawkish. John Williams with comments and so on. Yet you at Lombard Odier still see 3 rate cuts this year, even though we actually now have Williams allowing for the fact that there could potentially be a rate hike next. How do you see 3 rate cuts fitting into the rest of this year?
So Fed speak is important, but what happens to inflation is even more important. So if you know, our base case remains that inflation is going to continue to converge to a landing zone, let's say between 2 and 3% this year. Let me mention that, by the way, PCE inflation is already between 2 and 3%. Yes, PPI and particularly services in the CPI report is still at elevated level. That has a lot to do with construction element around housing and around insurance costs. But I don't think Fed speak is more important than what might happen to inflation. Again, if inflation surprises on the easing side in the coming 3 to 4 months, the Fed speak is going to change materially. Again, 3 months ago, the market and the Fed was, probably acknowledging several cuts, and then we had 3 months of tough inflation reports that can change pretty quick as well.